My name is Andrew Stotz of the Valuation Master Class, and I'm looking forward to our next presentation. This is a final presentation from a Valuation Master Class student who has spent the last 12 weeks working as much as 400 or 500 hours and is truly building a competitive advantage in company valuation. If you want to build a competitive advantage in company valuation, join us at valuationmasterclass.com. Let me bring her in. Well, how are you? You ready to go?
Yes. Hi. How are you doing? I'm fine,
I
thank you.
I'm good, and I know everybody's looking forward to hearing what you have to say, and I can't wait. So I am going to share your screen. One second, let me get that up there. All right, and whoa, I've never seen a report on this company, so I'm interested to learn as well. I'm sure the listeners and viewers are too. So, are you ready to go?
Yes, I am.
Okay, I'm going to remove myself right now. Go.
Okay. Thank you. Hello, everyone. My name is Islami Abdulatif, and I'm going to be presenting Group Casino today. I initiate coverage on Casino with a sell recommendation based on a target price of 1.1 euro, implying a downside of 48%. I derive my target price from a DCF based valuation using a WACC of 6.9% and a terminal growth rate of 2%. The highlights are stagnating growth in the French retail market, expansion into international markets that contributes to revenue, and digital transformation that supports competitive advantage. The risks are market saturation in the French retail market, execution of strategic transformation risk, ESG and reputational risk, and macroeconomic concerns and inflationary pressure. Now let's look at the background of Casino. In 1898, Casino was founded in France and has since evolved into one of France's largest retail groups. Casino operates hypermarkets, supermarkets, convenience stores, and e-commerce platforms under various brands. Aside retail, Casino has also diversified into real estate, energy, and logistics. Now let's look at the three key stories. Casino faces stagnating growth in the French retail market due to intense competition. Casino is a major player in the French retail market with 20% market share and a strong presence through its established hypermarkets and supermarkets. However, the growth potential in its domestic market is being severely constrained by intensifying competition. Expansion into international markets drive revenue. Casino's international operations have emerged as a key engine for growth. The international region accounts for approximately 5% of Casino's sales, reflecting its strategic importance to the group. Between 2018 and 2023, international sales grew at a CAGR of 8%, and I anticipate growth in international market contribution to sales to reach 9% by 2028. Digital transformation supports competitive advantage. Casino's digital transformation focus on e-commerce growth. Cdiscount has become a leading French e-commerce platform, leveraging data analytics for personalized shopping, investment in automated warehouses, and expanded click and collect services, enhance supply chain efficiency, and meet rising demand for convenience. In H1 2023, Casino experienced a significant revenue decline and has remained so until H1 2024. We'll look at why in a later slide. Now let's look at the latest news in Casino. Casino has outlined its Renewable 2028 strategy to focus on sustainable growth and profitability. The plan involves a refocus on convenience retailing, cost rationalization, and operational efficiencies. Also, Casino has made substantial debt repayment in 2024. The next major debt maturity is scheduled for March 2027. Constraints to growth are neutral in Casino PLC. A company needs to grow to increase profit and share price appreciation. Management's core financial mission is to deliver this growth to increase value of shareholders, to increase value to shareholders. Since growth is key, I like to consider constraints to growth rather than commonly discuss growth opportunities. I see four main ingredients: capital, operations, markets, and people. I rank them from major constraints to minor constraints. Capital is major because Casino operates with heavy debt, operations is neutral, markets neutral, and people minor. Revenue structure. Revenue shrank in 2022 majorly the reclassification of Exito, a major subsidiary, as a discontinued operation. 48% of Casino's revenue comes from Monoprix segment. The Farmprix segment contributes 17% to revenue. 14% comes from e-commerce segment, and 16% accrues from convenience banners. Now let's look at the Porter's five forces. 100% is the best, and Casino has a strong 63%, which means that competitive position is strong. Rivalry among competitors is pretty high, as there are many competitors of roughly equal size in the industry. We also see that there's high bargaining power of suppliers, and bargaining power of customers is also high. Threats from new entrants is high. I'm sorry, is not really high because we require a lot of capital and economies of scale to be in this business. While threats from substitutes is also high. Leadership and ownership. Casino separates its chairman from the group CEO. So we have Jean Charles Norrie as the chairman and president CEO as Philippe Palazzo. 41% of Casino's shares are owned by non-institutional ownership, and 59% is institutional ownership. Now let's look at the world-class benchmarking. I try to compare Casino with 600 large consumer staples companies worldwide, and profitable growth ranked in the bottom 10% among 600 large consumer staples in 2019 and 2021. Profitability has ranked in the bottom 10 for the entire period. Also, very weak expense control has been an headwind in profitability contribution. Sales growth ranked bottom 10% throughout, and expense direction has been volatile in the considered period. For global benchmarking, profitability has been performing in its worst percentile. Growth fell significantly after performing at its best. Asset utilization is stable near the bottom. Net margin is consistent at the bottom. And sales growth has also remained at the bottom. Net margin change has consistently been falling behind. Now let's look at the ESG analysis. Overall ESG score for Casino is 53%, with environmental contributing 40%, social 80%, and governance 40%. The company has implemented various measures to minimize its environmental footprint and reduce resource consumption. Casino has also been accused of not implementing sufficient policies to prevent environmental and social issues within its supply chain in a lawsuit. Casino has a human rights policy embedded in its ethical and CSR practices. It also has policies to promote fair competition and ethical business practices aligned with global compliance standards. 42% of directors are independent, which is in line with the legal minimum and above the 35% average in France. The company has faced some significant scrutiny in recent years related to insider dealings and accounting controversies, although the controversies are still in the preliminary stages. Now we have there my forecast for revenue. You see that revenue, I forecast revenue to continue to reduce up until 2027 when it will pick up again, majorly due to rising international contribution. Then we have here the balance sheet asset side. We also have the liabilities and equity asset side of the balance sheet. And we also have the cash flow statement. Here, the ratios, and the free cash flow data. On the forward 2025 PB multiple, Casino is trading at a negative compared to consumer staples sector in France, Asia ex Japan, and the global market. On forward 2025 PE multiple, Casino trades lower than its peers as well in the consumer staples sector in France, Asia ex Japan, and the world. I assume a risk-free rate of 1.3% and a market equity risk premium for the French market of 7%. Casino has been a high beta stock, so I assume a beta of 1.05, which is in line with its previous averages, resulting in a cost of equity of 8.7%. I use a terminal growth rate of 2% and free cash flow to the firm because Casino is matured and may issue or repay debt regularly. In my sensitivity analysis on the next page, the optimistic case assumes a gross margin of 30.3%, as resulting in a target price of 1.2 euro. Conversely, in the pessimistic case, the gross margin is assumed to be 26.3%, yielding a value of 1.1 euro per share. Here's the sensitivity analysis. Now, the main risk in the French The main risk is saturation is in the French retail market. Casino's heavy reliance on the French retail market, which is already highly competitive and saturated, limits its growth potential. Execution of strategic transformation risk. The Renewable 2028 strategy involves significant operational and cultural changes, including large-scale capital expenditures and stock reconfigurations. ESG and reputational risk. As consumers and investors increasingly prioritize sustainability, Casino faces pressure to meet environmental, social, and governance expectations. Any failure to align its operations with sustainability goals or negative publicity like controversies related to supplier practices would harm its brand and customer loyalty. Lastly, macroeconomic concerns and inflationary pressures. Fluctuating foreign exchange rates could impact earnings from international operations. I initiate coverage on Casino with a sell recommendation based on a target price of 1.1 euro, implying a downside of 48% from the current price of 2.2 euro. I derive my target price from a DCF based valuation using a WACC of 6.9% and a terminal growth rate of 2%. The highlights are stagnating growth in the French retail market, expansion into international markets that contributes to growth, and digital transformation that supports competitive advantage. The main risks are market saturation in the French retail market, execution of strategic transformation risk, ESG and reputational risk, and macroeconomic concerns and inflationary pressures. Thank you.
Okay, let me ask you some questions. Can you go to the P&L forecast first?
Okay. Here.
Okay. So, can you describe what happened? You already mentioned it, but I was a little bit surprised about the drop in revenue. Like all of a sudden, it became not a going concern for the subsidiary they had. Can you explain a little bit more about that?
So basically, when the 2022 reports were released, the revenue was not this low. So this 9,655 was a restated figure. I believe that it's an adjusting event that happened after reporting period. That was why it was restated to about 10 million in 2023 annual report. However, the main reason why this happened was because there was a discontinued operation of a major subsidiary in France. And also, of course, while it may not be major, we see that there is reduction in patronage with consumer behaviors changing, and this also contributed to this reduction. Also, as the company has diversified into real estate market, we see that the um, demand for real estate, the market demand for real estate is falling in France. So yeah, basically.
So if I look at the SG&A, it was 6424, then it came down to 2434. It seems like the success of this company going forward is going to have to do with cutting the SG&A, I'm guessing. Can you go to the ratio page?
Yeah.
Okay, let me just look at this for a second. So in fact, their gross profit margin is relatively strong, let's say at 25 up to
Yes, that's it.
28.5. And but their operating profit, operating margin or EBIT margin is negative, and it still is negative in the June numbers that they put out. So it seems like they still have work to do. Has the company made any announcements about trying to cut costs?
Yes, yes. And in fact, the Renewable 2028 strategy will be as incorporated strategic plans to ensure that cost is reduced and operational efficiency is increased.
But your assumption is that they're not going to be able to cut costs enough to
Yes, because sorry, please go ahead.
uh, so the idea is that they're not going to be able to cut costs enough to get to net profit in the next 4 or 5 years.
Yes, because their plan is to begin to effect in 2028. And my forecast,
Okay. Now, seems like we have some technical difficulty here. So let's hope that Islamia comes back. Hold on. So it's an interesting situation
Hello,
of this
Andrew.
company. Yes.
Sorry, I
Uh,
lost you for a while.
yeah. So how does it feel to graduate from Valuation Master Class? Well, we may not be able to get her back, but it's an interesting story about casino and what's going on there. So if you want to build a competitive advantage in company valuation, join us.